splendid evening it is to you viewers. Welcome to Equity News and Equity Access, your area of perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from our Hampton studios. I'm Ibn Mabunda. Let's get on to business. Well, it's a reporting galore following monetary policy pronouncements as well as guidance from the Public Accountants and Auditors Board. Now, to kickstart the reporting, NMB Bank held an analyst briefing in the capital today with a presentation of the 2018 financials. Let's get into the nitty-gritties. Net interest income grew 33% to $30 million, while net operating income also scaled 48% to $65 million. Fintech and point of sale actually playing a significant role in determining that increase in that regard. Profit after tax scaling 112% to $21 million due to improved operational efficiencies. Loan book growing 21% with an orientation towards mortgage loans in that regard. And according to the Chief Executive, Mr. Washaya, he says that this is a new introduction of a strategy by the corporation and is expected to yield positives going forward. I had to close up with the Chief Executive, Mr. Washaya. Let's have a look.
In terms of loans and advances, and a significant portion of that coming from mortgage loans. Is that the sentiment of the corporation going forward?
Mortgages, it was a new area for the bank, where previously we could not extend mortgages to our clients, and now we are in a position to do that. It all depends with the liquidity of the market. Because when it comes to mortgages, we are giving out a long-term money, and you must make sure that your deposits can sustain that. So if there's going to be a handicap in terms of giving out mortgages, it will...
In terms of loans and advances, and a significant portion of that coming from mortgage loans, is that the sentiment of the corporation going forward?
Mortgages, it was a new area for the bank, where previously we could not extend mortgages to our clients, and now we are in a position to do that. It all depends with the liquidity of the market. Because when it comes to mortgages, we are giving out a long-term money, and you must make sure that your deposits can sustain that. So if there's going to be a handicap in terms of giving out mortgages, it will be from a liquidity perspective.
I realize. Now to talk about the new HQ that you did explain that should be completed in the last quarter of 2019. What is the cost of that, and also what are the benefits that can be expected from a financial perspective with regards to the new facility?
Firstly, virtually all our head office departments will be under one roof, and they will also benefit from the layout of that head office, and it sends a statement to the market that we are here to stay. We are serious about our business. When we've got our own head office, which we own.
But in terms of the financial aspect of it, what benefits could be reaped then from that?
Obviously, we'll not be paying rent. That will be the major issue, and let me say the major part of that cost was in RTGS dollars.
I realize. Then lastly, can you shed more light on the $20 million facility that you said is earmarked for the local exporters?
Yes, it's a line that we are on the verge of getting from a regional bank. It will need to be repaid in US dollars, of course, and because of that, it will be exclusively for exporters who will be able to repay in US dollars, so that we can also repay our commitments in US dollars. We realize the importance of exporters in this country, and because of that, we are focused in assisting these exporters who are in the manufacturing sector, in the agricultural sector, mining, tourism.
Okay. Now that you just mentioned that this 20 million facility will be in US dollars, what is the asset structure of the bank with regards to the US dollar factor there?
The entire $20 million we have to go to those who have got capacity to borrow US dollars, to borrow and repay US dollars. So the entire 20 million will go to exporters who have good capacity to generate US dollars.
And another bank also released financials today. Well, of course, that would be Standard Chartered Bank, which issued financials for the 2018 financial year. Revenue growing 10% to $69.1 million from $62.8 million recorded in 2017. Total operating income increasing to $69.6 million from $63.1 in the previous reporting season. Interest income also scaling 39 to $39 million from $29.3 in the previous reporting year. Net profit also came in at $18.4 million in the period under review from also came in at $18.4 million under review against the previous season, growing by 38%. Chairman Mr. Love Mo Manatsa attributed the increase to the bank's operational efficiencies and a reduction in costs. Unlike other banks which recorded growth in non-funded income, Standard recorded a 4% decline in fees and commission to $33.9 million from $35.3 million recorded in the comparative period the previous year. Going forward, Mr. Manatsa said that the bank is scheduled to roll out its retail digital banking platform in the second quarter of 2019 to give clients the freedom of service in their electronic devices. This, of course, is in line with the trend across the sector. A lot of banks getting into the digital space, looking to have a significant footprint in line with global trends. Then, of course, in another sector, hospitality giant African Sun releasing financial results for the 2018 financial year. Well, let's just get into the teensy-weensys of who African Sun actually is. Well, of course, this corporation, they have hotels under management as well as owner-managed operations. Under hotels under management, they have, of course, Elephant Hills Resort Conference Center, Kingdom Victoria Falls. Then, of course, in owner-managed operations, they've got the Holiday Inn, then their flagship, which is the Victoria Falls Hotel. Let's just get into the statistics so that we get an appreciation of how the corporation has performed in recent years, right up to this point. 2014, they recorded losses of $2.3 million. 2015, a loss of 5.7, which of course was a double from the 2014 figure. 2016, they are back from the red into the black, and then they record a profit after tax of $4.9 million. 2017, there's a slight dip to $4.8 million against revenue of $21.8 million. 2018, they post a revenue of $68.5 million as well as a profit after tax of 10.1, which is a growth of 110%. Well, other details of interest would perhaps how, of course, they are looking to expand their capacity as well in Caribbean Bay Hotel as well as Great Zimbabwe by about 75 rooms. Well, also, according to the chairman, Mr. Makamure, he says that there has been a decline in the first 2 months of 2019 owing to violence in the month of January as well as macroeconomic instability. That's it for the news segment for tonight. Up next is News Review. Please stay glued to your screen. Welcome back, viewers. I'm now joined in studio by our very own investment analyst. To my right is Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Thank you, Ben. Good evening.
Fantastic. Then to my left is Respect Gwenz, who is the chief analyst. Respect, good evening and welcome to the show.
My pleasure, Eben. Good evening, viewers.
Beautiful. Let's get the ball rolling. We'll start from the hospitality, then moving right into the banking. African Sunday posting a very strong performance, and of course indicating how the growth in terms of occupancy has actually contributed to the growth in revenue. And there they recorded revenue of $68.5 million from 51.8. Tinashe, what is the relevance of such a performance?
Thank you, Ibn. If you look at the performance of African Sun, it actually benefited from the developments in the economy during the war for 2018. If you look at 2018, it was an election year, and with an election year, there is a lot of activity related to election conferences and such. So African Sun actually benefited in terms of increased occupancy, and even in terms of even improved average daily rate. You look at Africa Sun, it actually increased its average daily rate from $93 to $109 in line with the implied exchange rate in the market. So this actually drove, the increase in prices as well as the increase in occupancy level actually drove the revenue upward.
Okay, Respect, what is your comment on the performance in this regard?
I think this is basically a very solid performance, taking into cognizance that this is a company that has undergone restructuring, notably in 2014 when Brainworks took over the company, and they've managed to capitalize the entity. But more significantly, they've been using some tactical ways of trying to gain market share. And predominantly they've played around their pricing model, and they're now employing a favorable, a flexible pricing model, which allows people from different destinations to pay in their respective currencies, notably the rands as well as the other regional currencies, but it's slightly differing rates depending on the source market. But that has allowed some of the tourists who are coming from currencies which are possibly less favorable in terms of exchange rates to the USD to find Zim to be a more favorable destination because of the pricing impact. But in terms of the 2018 performance, I think this speaks to what Tinashe has said. There has been an increased activity in Zim, mainly driven by the elections, and also some other market activity that went on in that respective year. And this actually drove occupancy levels, and they've also been able to track their price upwards in a move that's reflective of market fundamentals, and that's why they were able to achieve superior ADRs and generally a very firm performance. And I think this is sustainable. There's still scope, especially in tourist destinations such as Vic Falls. Hotels have been running out of space, but there has been a need for such space as well, and then we are finding new entrants into that space, which shows the potential of the basic tourism sector. The very fact that the country is looking at moving towards a $10 billion sector by 2030 and coming from 1 billion now shows you how important tourism is to Zimbabwe. And obviously hospitality entities can ride on that. We are seeing a movement in the market, players moving, other players in the in basic property sector moving to construct some properties which are of hospitality nature. So I think this speaks to a generally firm 2018 coming out of an election period, as well as other sector developments.
Now, you mentioned the coming in of other players into the particular sector, while at the same time they're also building some facility that will house 75, that will build an additional 75 rooms. That's in Caribbean Bay, as well as in Victoria Falls. Over to you, Tinashe. given the fact that we have several players, ZPI has moved into the Old Mutual has acquired properties in Victoria as well as in Victoria Falls as well as Wange. We also have Lala Lodge constructing a 5-star hotel worth $15 million. Where does it place African Sun with regards to competition? I mean, their Crown Plaza facility here in Harare is just 100 meters from a Marsh Holdings properties that is now being converted into a hospitality structure. What is your assessment with regards to the competition that we now have playing in the hospitality industry?
Indeed, there is a lot of competition in that space. But if you look at Victoria Falls, for instance, it's one of the most strategic, area where each and every player, especially in the hotel industry, is actually to solidify his position or her position in that space. So for African Sun to invest, especially in Victoria Falls, it's actually a very good, strategic initiative to actually solidify its position. Victoria Falls is actually one of the areas which were identified by the government to be a special economic zone, to be actually the financial hub and the tourism hub of Zimbabwe. So those investments in that sector, they will help, African Sun to solidify and protect its market share in that space.
Okay.
I think if I'm also to come in with regards to that, if you're looking at market developments in the hospitality sector, there are definitely some new entrants. But I think African Sun stands out because they also offer some conferencing facilities, exceptional conferencing facilities within the Vic Falls hotels. And they've also been able to leverage from the relationship they have with Dawn Properties. They don't have to sweat on capital in order for them to achieve the desired structures. All that they have to do is to come and occupy a structure that is built by so they can grow at a faster rate, leveraging on Dawn. So Dawn's business model is that of constructing properties. Theirs is to manage properties. So rather, unlike other players who have to construct and then operate, theirs is simply to focus on management of these properties. And also, in terms of competition, I think why they stand out is also because they manage world or global brands. If you look at the Holiday Inn brand, those are very solid brands world over. And so people who are searching for hotels to occupy when they come to Zim, definitely Holiday Inn ranks ahead of any other such, outside of the ones that are due to come, the Radisson Blu and so forth. So I think they are strategically positioned in terms of maintaining market share and obviously even expediting, pushing up their growth.
Interesting perspective right there. Now, Tinashe, NMB records a very strong performance. Their profit after tax scaling 120 to 112%. Would you want to take us through the finer details of the performance of the group?
Okay, thank you, Ben. Banks have been releasing their results, and NMB is one of those banks that have released their results today. If you look at the profit level, profit has been on an upward trajectory from the low of 1.7 million in 2014 to the current all-time high of 21.2 million. What has been driving its profitability is actually NMB's shift towards more of a mass bank into the retail space. If you look at that in terms of income composition, your net interest income is actually the second largest driver of or contributor to total net operating income. Fees and commission income tops due to the bank's a massive investment in e-driven technologies such as your point of sales and the much famous NMB Kagwenya. So to take you through in terms of the finer details or the nitty-gritties of the interest income composition and the fees and commission income, you see that investment securities They are contributing around 25% to the net interest income, whilst your loans and advances are the major driver of the net interest income line. 73% of the net interest income is from loans and advances, which are your loans to your clients, which is also part of the mortgages, which NMB is actually has entered into. Interbank placements, they are coming in at 2%. Then in terms of fees and commission income, your digital, the investment into those e-driven channels, the POS and all other digital platforms, we are seeing that the contribution to fees and commission income, it actually declined from 58% due to the growth of the retail contribution as the bank expands into a mass bank. But you see, the digital income still enjoys the lion's share, which actually highlights the bank's massive investment into e-driven technologies or into e-driven channels. Then moving forward, in terms of the asset composition, your total assets has been going up more aggressively at a constant annual average growth rate of 17%, and were mostly driven by the growth in loans and growth even in the bank's cash position. Deposits have been also coming up as the bank has been in an aggressive deposit mobilization drive due to its expansion to a mass bank. Its equity is actually slightly below the 100 million, which is the minimum required capital set by the central bank for 2020. But we believe that the bank will also be able to meet its 2020 minimum capital requirement target. What's more impressive is the growth in the loan book. Over the years, we've been seeing banks are being more conservative in terms of lending, but NMB actually went against the odds and actually expanded its loan book, which actually grew by an impressive 27%.
Okay, I'll throw this one to Respect. What is your comment with regards to how the bank has performed over the period?
Yep, there's definitely a shift in strategy. I think this reminds us of FCB in the market, but notably, we are seeing a bank that's actually in transition mode. In 2017 onwards, they took a strategy to push more on the retail side. Previously, they were not a bank which was they focused more on the investment side and non-retail business. So they rolled out an exercise to try to accumulate more in terms of customers. And if some of the figures that they threw around, anything to go by, cash light accounts going up to between 6 and 8K thereabout, and the same margin as well in terms of Kagwenya, which is a low-cost POS machine. So that definitely speaks to the drive towards digital platforms, and that's why we are seeing a jump in terms of about almost 9.8 million in non-funded income. And when it comes to net interest income, the reason why we saw a jump in that figure is they took a deliberate decision to focus on mortgage lending, and most of the banks are tending towards mortgage lending because it's more securitized. If you fail to pay, we repossess your house. It's unlike an unsecured loan or a salary-based loan or some of those loans that are being extended in the market. So it's more, banks are tending more towards this kind of or equity release, if I may say. So there was almost a 30 million jump in terms of monies that were pushed towards that side of the business. So basically, I believe this strategy is a working strategy. But my worry is nearly all of the banking sector is moving towards a more aggressive approach in terms of lending, and also I wouldn't fault them for their movement towards digitalization. That's the future of banking, and definitely you gotta be into that space. Those who are not doing anything significant in the digital space are being punished. FCB, we saw a decline in revenue. Definitely, when you look at market share, you find that they're definitely down there. And when you look at Stewart Bank, these are the guys who are leading in terms of pushing up some technological advancement in banking. So definitely you will see the market also rewarding them for that. So in terms of non-funded income, I'm agreeable. I mean, this is the right strategy that they're taking. The market is feeling them. And in terms of interest income, they are definitely aggressing, but they are aggressing cautiously through mortgage lending. So overall, I think the bank is on the right footing, and the restructuring seems to be paying off.
Well, thank you, gentlemen, for the perspectives. We're just going to take a break. When we come back, we will get into the performance of Standard Chartered Bank. Please take a look at your screen. Welcome back, viewers. I'm still with our analyst here at Equity Access, Respect as well as Tinashe. Gentlemen, welcome back.
Sure.
Fantastic. Let's get into Standard Bank. A positive performance there being recorded, and well, it's been across the sector. I mean, Agribank, FCB, several banks across the board have actually posted a positive performance in that regard. Tinashe, please take us through how Standard Bank has actually performed in elaborate detail.
Standard Chartered, if you look at it in terms of profitability, Standard Chartered has been able, to grow its profits since 2016 on a more consistent, manner. From a dip of 0.4 million in 2015, Standard Chartered profit for 2018 grew to 18.37 million. But if you look what drove, Standard Chartered's current year profitability is actually cost savings. Its total cost or the whole expenditure, they managed to contain them. They only grew by marginally by only 1%. So in terms of income composition, Standard Chartered's total operating income has been actually driven much by your net interest income, which actually remains the major revenue driver. Your fees and commission income took a knock of about 4% from 28.1 million last year to 2018 position of 26.7 million. But if you look at over the years, Standard Chartered, we have seen a dip in terms of your fees and commission income line. What's actually happening with the Standard Chartered? It was one of those few banks that have not been able to grow its customer portfolio. if you look at other banks, they've been aggressive in terms of acquiring new customers. But Standard Bank, it took actually a deliberate decision that it's not opening any new other, customer accounts. So this actually contributed, to the dip in fees and commission income line. And if you also look at, in terms of what's happening in the market, in terms of those POS devices and the other, electronic solutions in the market, Standard Chartered has not been that aggressive in that space. But impressively, its net interest income has been growing at a more aggressive, and consistent manner. Maybe Respect, you might want to shed more light in terms of, the fees and commission income line for Standard Chartered.
Yeah, sure. I think I'll be pleased to share my thoughts on that. So definitely we're seeing a decrease coming from 2014 right up to 2018, where they're now sitting at minus almost 12 million thereabout in terms of what they're earning from fees income. But I think like what Tinashe said, this is a deliberate strategy by the bank to say we are focusing on a certain kind of clientele. Right. And this is not retail banking. If you are in retail banking, you have to have volumes, and those volumes, as people transact, then you are likely to earn more in terms of commissions and whatnot. So these are guys who deal with a specific kind of clientele, which is right up there and a bit in terms of retail. In terms of retail banking. So that has obviously seen them lose ground over the years. So much of the retail side of the business has obviously been going to more friendlier banks in terms of digital space, and those are the likes of Stewart Bank and all other, some of the several
late comers to the party. Second quarter, they said that they're coming in with some digital package.
Yes,
I do hope that perhaps it could actually alter the metrics here.
So this also speaks to the idea of leveraging on a parent, which is so you're not on the ground. Although the digital transformation is not a Zimbabwe focused thing, but the decisions at this respective banks is not taken rightly from Samora Machel. It's coming straight from London. So some of these some of these innovations and whatnot, they need prompt decisions. They need people who are rightly engaged on the market. So trying to align the needs of the market and the needs of the parent, that's the same challenge which we saw at FCB, formerly when they were under Barclays. Although Barclays is an international bank, right up there in terms of technology. In fact, they are the guys who started using computers in banking in Zimbabwe. But they've been slow lately to respond to the market needs. And some of the local banks have even moved ahead of them. So this is the very trend we are also seeing here in Stanchart, where they are losing ground. But I think that if they take a decision to operate more on the retail side and roll out more on digital platforms, then we might likely to see no further erosion. You have to contain that income line at a certain point, and they have to definitely invest for the guys who are their clients in that respective space.
I know you'd want to shed more light, but also in the same bracket, can you talk about the significance of the notice that they've given that they are, of course, increasing their transaction fees?
Yeah, increase in transaction fees will actually maybe add on, to improvement in the fees and commission income line. But maybe to add on, to the decline in that fees and commission income line over the years, you've seen Standard Chartered is one of the international banks that has been at the receiving end in terms of, penalties from the US government. Recently, we have seen that its parent was fined for Standard Chartered's involvement in the processing of, those OFAC listed individuals and corporates who are on US sanctions list. There is actually a time over the years, if I'm not mistaken, I think it was around 2014 or 2015, where Standard Chartered did actually stop the processing of all foreign payments. It was actually in light of these, the issues to do with the sanctions and the increased de-risking trend. So this has actually even affected its its ability to attract new clients. Because as a client, you'd want a bank which process whatever your transaction that we have. So Standard Chartered has been, not been able to aggressively, process those transactions. Your FX dealing income as well, it actually speaks to the same thing to do with, the de-risking and the issues of sanctions as well. Standard Chartered as an international bank, it should be one of the banks that should be able to, to trade much in foreign currency,
Sure.
leveraging on its parent,
yeah.
and also leveraging on its, brand. But we have seen
Sure.
your FX dealing income coming in at 3.2 million when compared to FCB's around 12 million. A Stanbic might come in at around more than 18 million.
Sure.
So these levels of 3.2 million, you can compare them, with domestic banks. These are actually speaks, to the increased de-risking trend and the breakup in correspondent banking relationships. Maybe moving on and maybe to shed more light in terms of this impressive growth in net income. For Standard Chartered, unfortunately, the increase in net income is not driven much by your loans and advances. It's driven much by your investment securities. It's the bank that has been holding, your treasury bills, investing much in government securities. But respect, do you think that strategy is sustainable?
Definitely, it is not sustainable. Why? Because the very reasons why government was borrowing in the first place was to cover what deficit there was in the economy. So now that there's a shift in strategy, government says we want to stop the tap. We no longer want to issue out more securities. What it means is that banks can no longer continue to earn the income from that respective line. But also, more significantly, there's been rising risk of potential default. Although this is sovereign debt, obviously it will have to be paid at some point in time. But there's been growing risks in terms of how government was continually increasing the rate at which it was borrowing, which definitely meant it could not match securities, as and when they were due, liabilities when they were due. So definitely this has not been the best practice in terms of interest income. So I don't think this is a sustainable way of investing, but hard pressed, this is what Zim bankers thought was the best way out. But as the economy turned out to be, it definitely looks clear that it wasn't going to be a sustainable way of investing. And in 2019, it's most likely that although government might taper off in terms of its growth rate or in terms of money supply. I'm sure you had the finance director NMB, he actually alluded to that, to say obviously government is taking a strategic decision to review its lending activities. So definitely they might not be lending more, but knowing our government to be what it is, it's just a matter of time. But this is not a sustainable way of growing income. It's only typical of local banks and not really foreign banks.
Okay, well, very quickly, Tinashe, last thoughts on the subject.
We are seeing also the bank, taking also, going the NMB route, increasing its lending through mortgages. We have seen, mortgages coming
Sure.
in at 1% in terms of, contribution to net interest income. What was Respect has been saying actually speaks, to the composition of Standard Chartered's assets. You look at your loans to the private sector. They've been coming down at negative 6% on over a 5-year period, and the loans to government, they have shot up by more than 400%. So lending to the government is actually crowding out Standard Chartered's capacity to lend to the private sector. But one may argue that if you look at the Zimbabwean market, there are not much quality borrowing clients, and there are increased risks in terms of lending to the private sector. So one may say we have so much liquidity lying idle on RTGS. So let me just hold your risk-free asset, which is your treasury bills. Maybe that's why we are seeing this bank increasing its lending to the government. Your deposits also, they've been going up at a constant annual average growth of 35%. This speaks to the brand to the stronger brand and even, a brand loyalty amongst its customers.
But I also feel that in as much as we try to allude deposit growth to in some banks new customer acquisitions, I also think there's an element of money supply. What am I saying? If money supply increases, then when government borrows and when it repays, it means somebody's account there's something that has been added to your initial outlay. So that definitely has got an effect of increasing the deposit level to the lender. So across numerous lenders or across a certain growth in money supply, it definitely also implies a growth in
Well, welcome back, viewers. Sincere apologies for the glitch in terms of our transmission, but we should be able to get on with it. Well, back to you, Tinashe. You were explaining something very vital with regards to the loan structure as well as the deposits in that regard. Please take it home.
If you look at Standard, its deposits, they have surpassed, the 800 million mark, and the loans to the private sector, they are just below, they are way below, the 200 million. It implies that there is a lot of liquidity which is not being, being utilized by this bank. So there is scope actually for this bank to increase its loan book, especially maybe to levels around 600 million. But maybe someone might say, these deposits, nothing much is being deposited in hard currency or in hard cash, which might support the needs of the industry and even individuals. If you look at most companies in this sector, they actually need your loans for working capital and even for retooling. So much of them, they are demanding their loans in forex.
Yeah, sure.
RTGS dollar, it doesn't support them that much. So the depressed loans growth might actually speak to the depressed lending activity in the economy, and also might also speak to the needs of the local industrial sector.
Yeah.
But
so I think I concur with Tinashe in terms of loans. The depressed nature of the loans, because when you look at the average loan to deposit ratio of the industry, we are sitting at roughly about 47% thereabout, which is definitely very low, below the NMBZ threshold of about 70%. But I think what's specific, what needs to be looked at is the nature of the deposits. The composition of our deposits is transitory in nature, and if you look at demand, most of the corporates, they actually demand forex, which is exactly what he has said. But now, what do banks do when they're left with they are sitting on that deposit base, which is transitory, and they have clients who are also not demanding RTGS dollar because they want to capitalize their operations. So you end up being exposed to a client base made up of retail clients, but those retail clients are also individuals. So you end up pushing your money in non-productive sectors, and these are individuals whose capacity to repay may not be up there. So that also increases the risk. So you find a very serious discrepancy in terms of loans to deposit ratio, and obviously government has been crowding out. Faced with that challenge, government has been playing, actually they found government to be a more favorable data. They've been lending to government instead. But the deposits growth, in my own view, is also supported by the very demands of government. The very reason why government is, the very reason that government is demanding money, which is pushing money supply, it's also in a way pushing up the deposits in the economy as well.
Now, very important, gentlemen, across the board, we've seen banks recording and reporting profits and positive performance all throughout, but they have ridden on what was some kind of a bubble that was playing out in the economy. But in terms of the outlook, what is it that we can expect from the banks? Are they going to maintain their profitability? What is going to play out with regards to the TBs that they have since acquired from the government? Would you want to shed more light with that is concerned, Tinashe?
But if you look at the sector in general, the sector is actually been benefiting, from increased transaction volumes, which has boosted their non-funded income line. This current, cash crisis has resulted in the economy being more of a cash-light environment, where everyone is just swiping or using mobile money for transactions. So we have seen bank now diverting from their traditional role of allocating capital from individuals who have got surpluses, your depositors, to those in a deficit. So we have seen banks now trying to compete more on transactional channels, offering your POS and your e-driven solutions. But for a bank such as Standard, I feel that it's a bank that is monitoring the current operating environment, and I see it as a bank that has a scope to grow at a faster rate. The increase in deposits, if the environment allows, I foresee a bank that may increase even its loan book to levels beyond your 600 million, which would drive its net interest income up.
Okay, respect. What is your analysis of the sector as well as, of course, the bank going forward?
Yeah, I think 2019 is going to be a bit of a challenge. There are a lot of dynamics at play. When you look at your funded income specifically coming from the interest rate component, it has not been favorable lately due to inflation. So definitely an adjustment is needed. And even if it comes, it might likely not be able to address the inflation adjustment issue. So you can't be increasing your interest rates to levels that are close to where the inflation levels are, and at the same time the alternative of lending to government might actually be shrinking as government takes a different stance. So banks have to continually look at ways of growing their income in the current year, and the place where they have to play a lot is basically in the non-funded income space, or lines of credit. But those lines of credit should mainly be channeled towards the productive sector, but specifically the export market, because they are able to repay in USD terms. So your ability to bring in lines of credit from outside will also determine the rate at which you grow, because you can actually charge good. You can actually put in an interest rate of 8%, or in fact of 10% in USD terms, which is quite favorable. But you cannot have a similar interest rate on an RTGS dollar loan. So I think as we move forward, it's important for banks to focus more on the non-funded side. For Standard Chartered, I think the decline in their non-funded income line is a good lesson for them to say, this is where you have to focus your efforts at. You are bleeding money, you're losing money, you have to re-strategize. So I'm seeing them roll out and be more aggressive and defend their territory in terms of their market share in the non-funded space. For the general banking sector, it's the same thing. We are still a cash-light economy. The newly introduced currency is basically an electronic currency to debt. So it means banks have to play more in terms of giving solutions or providing solutions in that space as well. So I mean, I see the banking sector generally deepening in terms of financial innovation and also financial inclusion.
Okay, and Tinashe, last thoughts?
There are actually risks, in the economy, and the major risk actually in the banking sector is, the decline or the reduction in correspondent banking relationships. Issues of sanctions, they are also increasing, the country risk. So banks actually, as agents of development, sometimes they might find it very difficult to negotiate for lines of credit and even process your foreign payments. So for the sector as a whole, I see 2019 is more for a challenging year for the whole banking sector, and banks they have maybe to look at other income lines other than the traditional line incomes. They have to be more innovative, maybe offering more e-driven solutions, and even your trade finance activities. So basically, that's how I see the banking sector in 2019 to date. It's actually proving to be a tough year.
Well, thank you, gentlemen, for the insights. Please stay with us. We're just going to take a short break. When we come back, it will be time for Markets Daily.
Welcome back, viewers. I'm now joined in studio by our analyst, Anesu Chimbum. Anesu, good day and welcome.
Good day to you too. Respect, how are you doing today?
I'm doing just great. Let's get into markets. 6 days of consecutive rising sessions. What does this mean for us?
I suppose we may continue to see this trend going forward with a couple of breaks in between, maybe one or two, because with the trend, it has been on an uprise for quite a long time, but then last week it did take a breather. Prior to that breather, there had been a consecutive couple of days where it had actually been rising as well. So with that trend having shown itself to be true for about 2 cycles now, we may be expecting a continued or sustained rise in the market. Demand is still very firm. It has been going up on a daily basis, average of about 20%. They're about trading around about 10-12 million today. We had about 23 counters that traded on the stock market. 16.
Yesterday it was 36.
Yes, yesterday was a year high of 36.
Sure. So basically the margin of gains has also been improving. We're seeing a average of 1.3 thereabout across them. That's a huge gain. When you look at this average stock market, the gains normally are between 0 point something, but we are seeing an increase. If it was in terms of cyclone, we'll be seeing it, gathering momentum and so forth. We'll be telling of increased magnitude in terms of, and that's exactly what's happening right now. We are seeing a market in gaining mode, but the margin of growth is actually going up.
Also, so that magnitude is also picking up some.
So the ZSE all-share index up 1.28 to 128.62. Industrials 1.29 to 42939. The top 10 up 1.51% to 12238. Only the mining index down 0.22.
Yes, it did give in as BNC did later prior session gains. We had a couple of top 10 rises on the stock exchange today, which actually really influenced. Econet being amongst the top 5 risers. We actually had 16 risers and 3 laggards today. BNC being the only mining company in that area. For our 5-day trend, we are now up 2.1% for the all-share index, 2.5% for the top 10, 2.13 for the industrial. Now the mining's index is only down 0.17% on a high base effect there, working around about there. As we were speaking about 16 rises and 3 laggards, Mikos was leading that pack of bulls actually, coming up 17.37%, 47 at 60 cents. Econet being among the top 10 was up 4.95%, which was the strongest performing counter in the top 10 index actually. Sure. on this particular day, coming up 4.95.
Think of interest there, Old Mutual up 2.11%. The local unit is scouting for a new CE. That's as of today. I think the information is now circulating in the market.
Okay.
But clearly Old Mutual PLC, Old Mutual Limited, which is the JSC listed and ZSC secondary listed, has been gaining traction on the market. Investors definitely wanting to have a grab on that stock as a way of trying to obviously hedge their positions against vagaries on the interbank market. But I think this is one of the counters that has definitely kept the stock market rising in the recent past. Okay, let's move on to today's forex market update. A chart yesterday at the ZITF, fully charged, and we had our dear VP speaking about sabotages and possible collusions in the market by business leaders trying to sabotage the FX market. Your view?
Well, I think to an extent he may be onto something, because you would realize that there are some prices that are now being charged at a higher cost in terms of US dollar terms. For example, today I was pretty much shocked by by my new bill for my Zol internet. I mean, 1 gig is now costing $2. It doesn't literally make sense for me at the current moment, and such kind of price hikes are a little bit worrying. I really wonder if they are really to put a price commission in place, there could be a space where they could actually regulate rather not put caps, but then make sure that they are fair increments. I mean, yes, things are doing.
But the issue at the end of the day, it's about perception. How does the market view your move? Do they feel that you're controlling them? They feel that you're manipulating?
I mean, his statement was very strong.
Yes. So if you're a whole finance, if you're a whole VP going on the podium and telling business people to stop it, what does that mean? What sentiment are you sending to the market? I think at the end of the day, we got to read how the market reads it.
Yes.
Because how the market reads it is how it plays out on the interbank market.
Yes,
so I think that's where the issue is. If you're gonna introduce a commission, I mean the same way as you're saying right now, would the market take it as a normal move, or would they try to even take some more cautious moves to protect their monies? My general view in all this is, where this price increase is there in a dollarized economy, why were we having competitive prices? Although they were high, the margins were high, but the pricing was competitive, because you know that there's going to be an import which is going to come to take your market. What's happening today? Why are people charging the prices in this way? Anyway, that's a story for another day. Let's look at what happened in terms of the interbank.
Well, the interbank did weaken, coming up to about 3.23 cent dollars for RTGS dollars for $1, while the old mutual implied rate and the parallel market almost did converge today, trading at about 4.7 for the old mutual implied rate, while the old mutual implied rate was at 4.73, and the parallel market was at a steady 4.7 as at yesterday as well.
So we are having a February to date gain of almost 30% on the interbank market, and there seems to be tendencies of further erosion. Industry coming out to say at these rates we are not likely to release money because we feel that that's not reflective of the true market forces.
And consequent to a very strong statement by the VP, it could even worsen. If you could cap the show for us.
Thank you, viewers. Stay tuned for the next segment.
Well, just quickly before we go, Respect, what is the outlook with regards to what we can expect in the economy?
I think it's a roller coaster. It's not yet stable. I mean, the market is not yet stable. In the economy, there are a lot of issues going on, and the most topical one being inflation, and obviously issues to do with interbank. The interbank is going to dictate mainly the direction of inflation and whatnot. The government insists that our books are balancing, running on a surplus, but the market seems not to believe in the story anymore. And when perception is on the negative, then obviously the outcomes in terms of the real playing on the ground is not going to be favorable as well. So I think it's going to be it's a belt tightening situation. People have to brace for at least more hardships, and I don't seem to have it in sight to say we are likely to emerge out of this in the very near term. I'm not of that view.
Well, it would be interesting to see how the story plays out. Well, thank you, Respect, for the perspectives. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website, www.equityaccess.net. From the team at Equity and I, Danky, and ciao!